Holy flippity flip flop flap and smokes, everyone. We have just got the first sign that this stock market rally we're on, this irrational exuberance, this bear market rally, this trap that we're in right now is over. We just got a bombshell, new reports of earnings that were released today for some of the biggest companies in the world. And what these earnings reports are telling us is something that I've been trying to warn people all along, that the economy is weakening, people are spending less money, and companies' earnings are about to fall. And we did just get these new earnings reports today. And they'll buy some of the biggest tech companies on the stock exchange. That was not Facebook, that was yesterday. That was Google, Apple, and Amazon. Now, first things first, Apple. Apple is the most important because I don't know if all of you know that Apple has the most weight in the indexes. That's the most expensive stock listed on the New York Stock Exchange. So when Apple goes down, that affects all the indexes, the S&P 500, the Nasdaq, etc. Now, Apple had one of its biggest earnings misses since 2016. They missed, their revenue dropped around 5%. Now, obviously, this is because what happened in China. There was huge protests at one of their factories. I did a video on it last year, and I was saying this is going to affect the iPhone production. It was going to affect iPhone sales, and it was also going to affect their earnings. So Apple, again, this is a quick summary. I'm going to go into more detail over it tonight, but this is a quick urgent one. They had a big miss. Okay, as well as Google, their revenue is falling. Their advertising revenue is falling. And something interesting that came out from Amazon's earnings is their actually advertising revenue went up 19%. So they're starting to take some market share from Facebook, from YouTube, etc. with the advertisements. Maybe they're shortcutting YouTube and Facebook like they do with their other businesses. So Google's revenue was down. Now also Amazon, they just beat their earnings expectations, but they gave light guidance. They're having big issues. They're saying the economy is weakening, the consumer's weakening, and they think their revenue is going to continue to fall as well. So these are three of some of the biggest companies, if not the biggest companies in the world. This is showing that what the Federal Reserve has done with their rate hikes, it is showing that there's a lag. And we're only now just starting to get the data of the effects it's having on the economy. And again, people, it may sound like a broken record, but we haven't even hit peak interest rates yet. Yes, while the Federal Reserve gave some pivots, while the Federal Reserve, should I say, gave some hints that they may pivot within a couple of months, or they're saying they may pause. This was all expected. We knew they're going to go to 5% and then pause. But what this market is rallying on is they think the Federal Reserve is going to start cutting late this year. But I don't think they're going to, or I don't think they will be able to. And if CPI comes in hot for January, anything over, I think 0.4% for the month, that's going to be bad news for inflation, because then that means that inflation is still increasing. And what can happen with inflation is it can go down for a few months, but then it can rebound and skyrocket again, like we saw in the 70s and 80s. So I think that this market rally cannot be sustained unless there's something some Wall Street banks know that all of a sudden the Federal Reserve is going to start buying stocks or something, or they're going to all of a sudden say, look, we don't even care about inflation anymore. We're just going to print because the US government is facing bankruptcy. Unless there's some insider knowledge that we don't know about yet, because, I can't predict data that hasn't come out yet or information that hasn't come out yet. Unless there's something that these Wall Street insiders know there's going to be some huge announcement, I think this is just a typical bear market rally. And again, we've had these rallies. Some of the most violent rallies we have throughout history have been when we've had the biggest crashes. Through the dot-com bubble, through 2008, we saw big rallies. So what I expect to happen, once the Federal Reserve does a couple more rate hikes, we're going to see companies announce weaker and weaker earnings. Now, many people are saying, by the dip, the market crashed, 25% for the S&P 500, 35% for the Nasdaq. They were thinking these were bargain deals. But people, they aren't a bargain. Stocks are still overvalued when you look at the price to earnings ratio. When you look at the Warren Buffett indicator, they're still about 30% overvalued. So Stocks aren't cheap. Yes, they've come back from their highs, but they're coming from extremely overvalued prices to just slightly overvalued. So it wouldn't really be a bargain for these, especially for these tech stocks, until, you know, the price to earnings ratios come back down to around 15. So again, what you're probably wanting to know, well, okay, what does all this mean for you in simple terms? Well, what this means is, everyone, we haven't felt a full effect of these rate hikes. I think coming over the next 6 months, the data is just going to get worse and worse. We're going to see, you know, companies having to announce more and more layoffs. We're seeing this is a big cost for a lot of these tech companies to, you know, pay severance for the employees, pay them out when they're firing them. So we're going to see more and more layoffs, and it's really, that's going to be the final nail in the coffin when the unemployment rate goes up, because people are surviving now. Maybe they're getting a little bit of a pay rise to somewhat keep up with these high prices, but we all know in real terms, we actually have got the data that real disposable income has dropped its most since 1932. $1 trillion in real disposable income has been wiped out. So once people start losing their jobs, that's when we're going to see the real pain hit, the real pain, because we have had a bit of pain yet, but we haven't had major pain. Okay, so once that happens, that's when we're going to see things really hit the fan. So what I'm doing right now to prepare for this, again, I said in my video, I've been buying gold and silver, because even if the Federal Reserve does pivot, well, the US dollar will go down. That should perform well for gold. But if the Federal Reserve doesn't pivot and we have a very bad recession or an economic crash, stocks are going to fall much more than gold and silver. Even if gold does fall, like what we saw last year in 2020, it won't fall as much. It will hold its value much more. So I've had a plan all along. I've been telling you guys, you know, there's some YouTubers that one day when the market's green, okay guys, I think the market crash is over. Then all of a sudden, when the market's red, like, okay, the crash is back on, I'm selling all my stocks. They just go wherever the market goes. They flip their opinions based on whatever the charts do. But me, I've been consistent. I've said I'm waiting for the S&P 500 to fall 35% from its peak. For Bitcoin, I've dabbled in around 16, 17,000. But I was really waiting for around that 13,000 level. There still may be a chance that we hit that. But with the halving coming up next year, I think as we get close to late 2023, Bitcoin is going to start rallying again, but that's a very speculative play. I wouldn't allocate more than 5-10% of your portfolio to that. So that's what I'm doing. Dollar cost averaging into gold, silver right now, building cash on the sidelines. I think we haven't seen the bottom yet for stocks and crypto, but when we do, that's when we're going to buy the real mega dip, and that is when the real money's made, people. But you just have to be patient, okay? So for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.